Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe. And all these option videos are sponsored by myself. So these are the weekly trade zones for the S&P Emini futures. $50 one-time payment for a lifetime subscription. I've been doing these for about 7 or 8 years now. And every weekend I send you all these trade levels. Again, $50 only. Go to daytradingfearless.com or click the link down below in the description. And also make sure you check out my Patreon page at patreon.com/daytradingfearless to follow along with my trading portfolio. So, with that being said, let's jump into the option video course, and I hope you guys enjoy it. And thank you for watching. Okay, in today's video, we're going to talk about long/buying calls, right? If you get long a call or you're buying calls, they're the same exact thing. Okay, so don't be confused by that. Okay, so whenever you are buying calls, your market opinion is bullish, okay? And you will always pay a debit whenever you're buying calls. A call option gives the buyer of the call the right, but not the obligation, to buy the underlying stock at the option strike price. The seller of the call is obligated to deliver/sell the underlying stock at the option strike price to the buyer of the call when the buyer exercises his right. You will want to buy a call if you think the stock price will go higher. That's it. Very simple, very basic. So here's an example. We're going to buy one XYZ October 20 call for a $1 max loss, okay, which equals $1 debit that you would pay, and your max profit is unlimited, while the break even is if the stock closes at $21. So an example with this would be stock XYZ is trading at $20, and you think in the next 2 months the stock will trade well above $21. So you could buy the October 20 call strike for $1, which means that your maximum loss is only $1. Okay, remember with options, it's a multiplier of 100, so it'd be $100 loss. That's it, a max loss of, right? And you will need the stock at October expiration to be above $21 to break even, and also you have the right to own the stock long at $20. Now remember, you paid the $1 premium, so your real break even's $21, but you're probably not going to get along the stock if we're under $20, right? Or even maybe at 21 you will, because there'll be a break even, and then you could stay long the stock. So if by October expiration the stock is at $25, then you can close out the option with a $4 maximum profit. The difference from your break even to your closing price of the option, okay, which is $21, your break even, to 25 equals a $4 profit. Okay, so let's take a look at a couple examples here, okay? And let's come over here, and let's say we'll look at Viacom again, okay? And let's say we want to get long Viacom at, we'll say $41. The stock's currently at $40.73, and we want to get long at $41. With 30 days left, well, we know that the bid ask, okay? And a lot of times when you see me, I'll usually quote the mid price between this and this, right? So the mid price will be about 262, okay? Or sorry, 272, right? The bid is 267. The ask is at 276. So we'll say 272 is where we would want to buy this stock, right? So at $41, okay, we could get long, but we then have to add $2.76, right? So what we'll do is we'll grab a calculator, okay, and with the calculator, we're going to go $41, and we're going to add the 272 to it, right? So plus 2.72. Okay, and that gives us a break even of $43.72, right? Well, the stock's at $40.73. So we need the stock to essentially rise almost $3 from this point to just be at break even come options expiration, right? Now, remember, if we get the move quickly, if with the delta, okay, and we're going to start tying in things we've talked about in previous videos. Remember, we have a 52 delta, so I know that if I buy this option right now for 272, right, that come expiration, and if you think about it, here, let's do this, right? Let's go 272 here, okay? And we could see we're buying one call, right? Our break even will be 43.72. Max profit is infinite. Max loss is $272, what we pay for the option, the cost of the trade, right? And our result of buying power. We can't lose more than what we pay for the option, right? So we know that that is what the number is going to be. But here's the thing is, if all of a sudden the stock rallies $1 today, okay, let's say that we're intraday, the market's moving, and all of a sudden we just have a spike to $41.73. Well, what we paid 272 for, okay, 2.72, well, if we know that the delta is 52, we know that a $1 move higher, we will make about $52. So 0.52, okay? And this option should be worth about $3.24. And we would make essentially $52 today. Now, the longer this takes to move $1 higher, okay, is where theta comes in. And with theta, as theta just starts to tick away, if we pull up theta, we will see every day that the stock doesn't move higher, right? Let's say it just moves up 10 cents or whatever tomorrow. Well, we're going to lose 5 cents worth of time decay. So that, I hope that kind of helps understand, okay, what buying a call is, using the delta, understanding the theta, and all those other things that go along with it. So that is the video for buying or being long calls. Until our next video, we'll talk to you soon.